A bond ETF is a type of exchange-traded fund that invests in bonds. Bonds are fixed income securities that pay interest to investors. Bond ETFs allow investors to gain exposure to the bond market with low costs and high liquidity. There are many types of bond ETFs that focus on different categories of bonds. Some examples are Treasury bond ETFs. These invest in bonds issued by the U.S. government. They are considered safe and have low credit risk. Corporate bond ETFs. These invest in bonds issued by companies. They have higher yields and higher credit risk than Treasury bonds. Municipal bond ETFs. These invest in bonds issued by state and local governments. They have tax advantages for some investors. International bond ETFs. These invest in bonds issued by foreign governments or corporations. They have currency risk and political risk. Bond ETFs work by tracking a bond index, which is a basket of bonds that represent a segment of the bond market. For example, the Bloomberg U.S. Aggregate Bond Index tracks the performance of the U.S. Investment-grade bond market. Bond ETFs hold a portfolio of bonds that match the characteristics of the index they track. They trade on stock exchanges like stocks, which means they can be bought and sold throughout the day. Bond ETFs pay interest to investors through monthly dividends. They also pay capital gains or losses through annual dividends. The price of a bond ETF depends on the supply and demand in the market, as well as the changes in interest rates and credit quality of the underlying bonds. Bond ETFs have some advantages and disadvantages for investors. Some advantages are diversification. Bond ETFs provide exposure to a large number of bonds with different issuers, maturities, and ratings. Low costs. Bond ETFs have low expense ratios and no commissions or sales charges. Transparency. Bond ETFs disclose their holdings and prices daily, which makes them easy to evaluate and compare. Liquidity. Bond ETFs can be traded anytime during market hours, unlike individual bonds, which may be illiquid or hard to find. Some disadvantages are tracking error. Bond ETFs may not perfectly replicate the performance of their index due to fees, sampling, or rebalancing. Premium or discount. Bond ETFs may trade at a price higher or lower than their net asset value, NAV, which reflects the value of their holdings. Interest rate risk. Bond ETFs are sensitive to changes in interest rates, which affect the value of their holdings. When interest rates rise, bond prices fall, and vice versa. Credit risk. Bond ETFs are subject to the risk of default or downgrade of their holdings, which can reduce their value and income. Bond ETFs are a convenient and flexible way to invest in the bond market. They offer income, diversification, and access to various types of bonds. However, they also have some risks that investors should be aware of before investing. Bond ETFs are exchange-traded funds that invest in various fixed income securities, such as corporate bonds or treasuries. Bond ETFs allow ordinary investors to gain passive exposure to benchmark bond indices in an inexpensive way. However, bond ETFs also have some risks and drawbacks that you should be aware of before investing in them. One of the main risks of bond ETFs is interest rate risk. This is the risk that the value of your bond ETF will decline when interest rates rise. This is because bond prices and yields move inversely. When one goes up, the other goes down. When interest rates rise, bond prices fall, and vice versa. This means that if you hold a bond ETF with a long duration, or a measure of how sensitive it is to interest rate changes, you will lose more money when interest rates rise than if you hold a bond ETF with a short duration. Another risk of bond ETFs is credit risk. This is the risk that the issuer of the bonds in your ETF will default on their payments or go bankrupt. This can cause the value of your bond ETF to drop significantly, especially if you invest in high-yield or jump bonds that have lower credit ratings and higher default probabilities. Credit risk can also affect the liquidity of your bond ETF, or how easily you can buy or sell it on the market. If there is a credit event or a market disruption that affects the underlying bonds in your ETF, you may not be able to sell your bond ETF at a fair price or at all. So how can you redeem your bond ETFs before they lose value or mature? There are two main ways to do this: selling them on the secondary market or receiving cash distributions from them. Selling your bond ETFs on the secondary market is the most common way to redeem them. You can do this by placing an order through your broker or online platform at any time during trading hours. You will receive the market price of your bond ETF at the time of sale, minus any fees or commissions. This way, you can lock in your gains or losses and avoid holding your bond ETF until maturity. However, selling your bond ETFs on the secondary market also has some disadvantages. First, you may not be able to sell your bond ETF at the price you want or expect due to factors such as bid-ask spreads, market volatility, liquidity issues, or tracking errors. Bid-ask spreads are the difference between the highest price someone is willing to pay for your bond ETF and the lowest price someone is willing to sell it for. Market volatility is the fluctuation of prices due to supply and demand forces. Liquidity issues are the lack of buyers or sellers for your bond ETF in certain situations. Tracking errors are the deviations of your bond ETF's performance from its underlying index or benchmark. Second, selling your bond ETFs on the secondary market may trigger tax consequences. Depending on your holding period and tax bracket, you may have to pay capital gains taxes on any profits you make from selling your bond ETFs. Capital gains taxes are taxes on the difference between your selling price and your cost basis, or what you paid for your bond ETFs. If you hold your bond ETFs for more than a year, you will pay long-term capital gains taxes, which are lower than short-term capital gains taxes. If you hold your bond ETFs for less than a year, you will pay short-term capital gains taxes, which are higher and equal to your ordinary income tax rate. Receiving cash distributions from your bond ETFs is another way to redeem them before they lose value or mature. Cash distributions are payments that your bond ETF makes to you periodically, usually monthly or quarterly, based on the interest and principal payments it receives from its underlying bonds. You can use these cash distributions to reinvest in other securities, spend on other expenses, or save for future goals. However, receiving cash distributions from your bond ETFs also has some disadvantages. First, you may not receive enough cash distributions to cover your initial investment or meet your income needs. This is because cash distributions depend on factors such as interest rates, credit quality, maturity dates, and reinvestment rates of the underlying bonds in your bond ETF. If these factors change unfavorably over time, your cash distributions may decrease or stop altogether. Second, receiving cash distributions from your bond ETFs may also trigger tax consequences. Depending on the type and source of your cash distributions, you may have to pay income taxes on them. Income taxes are taxes on the money you earn from your bond ETFs. There are two types of income taxes: ordinary income taxes and qualified dividend taxes. Ordinary income taxes apply to interest payments from your bond ETFs and are equal to your ordinary income tax rate. Qualified dividend taxes apply to certain dividend payments from your bond ETFs and are lower than ordinary income taxes. However, not all dividend payments from your bond ETFs are qualified, and some may be subject to ordinary income taxes or even higher taxes. In conclusion, bond ETFs are a convenient and cost-effective way to invest in the bond market, but they also have some risks and drawbacks that you should consider before buying them. If you want to redeem your bond ETFs before they lose value or mature, you can either sell them on the secondary market or receive cash distributions from them. However, both methods have some disadvantages and tax implications that you should be aware of. Therefore, you should consult your financial advisor or tax professional before making any decisions regarding your bond ETFs.